the imputed growth point that you're talking about, which you say that is sustainable for private banks, what the market is pricing in today, would you say the same of the expensive NBFCs, where the market might be imputing 30% or 40% growth in some cases for the next 8-10 years?
I think there is a bubble there because many of them don't have really differentiated processes, or so they have been benefiting from the lack of lending by the the state-owned banks, and they're willing to take high risk. But at some point of time, I think some of them are going to implode. I'm not saying all. Some of them might be in niches where they have strengths, in terms of, it might be something to do with, consumer durable lending, where they, have deep relationship with the dealers, or, things like that. But for those exceptions, the average NBFC, there's no reason why they will be able to sustain these type of margins and credit quality.
Where do you stand on this affordable housing theme, which has become a very popular one in India, with lots of sectors have been re-rated on the back of that? Do you buy it?
There's a huge opportunity, but to get it going, it's not that simple, because we didn't have large developers. If you look at China, there are so many large developers. Each of them can, develop so many times more space than our biggest developer. They are used to that. The land procurement mechanism is very easy there. The states allocate, the provinces allocate land. So in India, I think procurement of large tracts of land is a challenge. The ability of the builders to scale up is a challenge. And then the pricing to be right is a challenge. But I'm sure the government is working on some, resolving some of those issues. I do expect progress, but I think the momentum to build up, I think, is going to take at least 2 to 3 years.
One question on the capex cycle and how to approach industrials back in India now. What would you say was the right approach? So this is a problem I have with most of the people who are, complaining about capex. I think one thing they don't understand is the basket of spending is changing. You and I, if we get more money, we're not going to spend on the same things that we were buying 10 years ago. If we have an automobile, we're still going to have an automobile. Might be it's a slightly better quality automobile. But I think the biggest change is in things like electronics. I just counted the number of Apple products I had at home, and then we, in a family of 3, we had 10 Apple products. There's going to be demand for that. If we can manufacture in India, I think there's going to be a huge capex opportunity. And this is exactly what I was pointing out to the finance minister as well. We need to have a program, the Make India program, that should focus on what people need. And electronics is something which people are going to need more and more, both the consumers as well as the corporates. There's going to be more automation in every factory. It's not just the cement plants that we need. Yes, we do need a little more of them. We do need a little more of the steel plants. But I think the biggest opportunity is going to be in areas like this. And for this, I think we have to solve many problems to have capex in these type of areas. And when we solve them, I think there's going to be a big opportunity. Otherwise, there's going to be some pickup, but it's not going to be that big unless we get into areas like this. You spoke about a contrarian call in IT a few years back. What's your biggest or highest conviction contrarian call today in Indian stocks? Either on the expensive side, or where you are betting against, or the ones which people do not like, but you're happy to go out on a limb on?
So at this point of time, it obviously depends on the price of the stocks. So the way the market is pricing in stocks, in our India portfolios, our portfolio managers are underweight information technology, because when we look at the services companies, we do not think that the current market prices, is still overestimating the growth potential for most of the companies. So when we have made some beginning in property, we think it's going to be a big opportunity over a period of time.
Okay.
But traditionally, the corporate governance of the property companies were pretty low. Now there are a few companies which are trying to differentiate themselves. I think they should see a lot of opportunity. That's a space that we would like to, watch out and invest more if viable business models emerge. I think retailing, can be a big opportunity. I think there were a few failed retailing companies because they were too optimistic and they didn't have very robust models. But I think there are more companies which are going to try and test various models, and some of them have successful formats which are pretty profitable and they are expanding. I think there's going to be good opportunity in retailing. I think there's going to be a good opportunity in healthcare, but not necessarily selling the same type of medicines. I think it's going to be in terms of services, differentiated products, etc. So I think these are areas that we are watching for. Yes, private sector banks is among the large sectors. I think we still have.
What about telecom? Are you willing to take a contrarian approach to that?
Yeah, so we took a view that there will be consolidation, and for a while we were right, and then it didn't work because one large corporate stepped into that field, and then everything changed. Yeah. Yes, I think there is going to be consolidation. Now it's going to become a three-player market, clearly. But the extent of pain can continue for quite some time, because when we look at Reliance, which has entered, they're not going to be satisfied with the current market share. So they're going to play for higher market share. And as long as they are playing for that, I'm not sure whether the pricing can allow good return on capital. So I think there's a longer-term opportunity, but it comes with a lot of risks and pain.
For people who are buying stocks today, you mentioned in passing that maybe return expectations need to be moderated. Do you think it's a given that when people walk into mutual funds today expecting that the long-term return would be close to 15% a year, do you think that's being optimistic from this kind of entry point, or should one set one's sights a little lower?
Right. So when we are looking at the world and India, I think equities are still very attractively priced compared to other alternative investments. So we are looking at the implied equity risk premium. In the long term, the equity risk premium is about 5%. That means the equity investors to come into the equities, they were looking at 5% extra returns compared to fixed income. In most parts of the world, now it's 7%. In India, it's also, I think, close to 7% at this point of time, compared to the long-term average of about 5%.
The risk premium is 7%.
7%.
So we should be expecting 7 plus 7 fixed income, 14%?
7 plus 6 or whatever.
Okay.
So I think the implied equity risk premium is 12 to, implied cost of equity in India is about 12 to 13%. So I think there is enough margin of safety in the current valuation in relation to debt. So if the cost of debt keeps going down, equities will become even more attractive compared to debt. So which means that there has to be a higher allocation towards equities. So I think equities are still globally and in India very attractively priced in relation to debt, and probably much better than real estate in any case.
On that note, Sukumar, thank you very much. Appreciate your time today.
Thank you, then.